Shorting doesn't have to be scary or risky. It can actually be an incredibly useful tool for traders and investors. In fact, I've been shorting to hedge my portfolio for most of this bear market, and I'm very happy with my results so far. So if you want to learn how to short responsibly, then you're in the right place, because in this video, I'll share with you everything I know. I'll cover basic definitions, common questions, my personal strategy, and a step-by-step tutorial of how to short on Bybit. Okay, so I actually wrote a 20-page guide that covers how to short to hedge from start to finish. But you probably don't want to read all that, which is why I'm making this video, to walk you through that guide and summarize the key points of each section. I'll leave timestamps below so you can jump around, but I highly recommend you watch the whole thing so you don't miss any important steps along the way. Also, I want to stress that I'm teaching responsible shorting as a way to hedge, and I'm not going to teach you how to day trade like a degenerate gambler. So keep that in mind while you watch this video, and without further ado, let's get started. And here it is, our short to hedge guide. It's quite the beast, but don't worry because I'll walk you through each section and summarize it for you. We got to start with the disclaimers. Number one, I don't guarantee the safety or viability of any platform or exchange mentioned here. So just be careful, spread out your capital, and don't run into another FTX situation, please. Number two, I'm not going to teach you how to day trade, swing trade, or gamble with leveraged products. I'm going to teach you how to hedge, which is a much more conservative strategy. It's not risk-free, but it is lower risk than those things I mentioned. Number three, Bybit is our partner for this guide, so during the tutorial portion, I will show you how to use them step by step to open a hedge position with shorting. But what I teach you in this guide would apply to any platform, generally speaking. If you do decide to use Bybit, though, to follow along the tutorial, then I would really appreciate it if you use my referral link that I'll link you in the description below, because that would support me and help me out. Number four, even if you don't want to hedge right now because you think the bear market is over or the lows are in, you can still use this information in future bear markets, so it's good to learn it now rather than later. In this guide and this video, I'll share with you three main sections. Number one is the basic concepts of shorting and hedging. Number two is my personal strategy for hedging. And number three is a step-by-step tutorial of how to short to hedge on Bybit. And let's get started with the basics. There's going to be a lot of definitions and different frequently asked concepts that we're going to go through in this section. What is shorting? Well, just know that it's a technique that you can use to kind of bet on a price decline of an asset. This is different than what we usually do. Like when we go long, when we buy assets, we want the price to go up, right? Because if the price goes up, the position that we opened will also go up. But in this case, shorting, when the price of the asset goes down, the value of the position goes up. So it's the complete opposite of going long. I'm not really going to go into the specifics of the step-by-step process of like borrowing an asset, selling it, but that's technically how shorting works. And there's also other products that let you to go short, effectively speaking, that I'm going to touch on in a later section. Reasons to short. There are a few main reasons. Number one is to speculate on price drops and profit from it. This is kind of risky though. It's like day trading or swing trading. Number two is to go delta neutral. This is more complicated, complex pro trading strategy. I'm not going to touch on that too much. Number three is to avoid a taxable event, because in some jurisdictions, if you sell an asset that you held, then that would trigger a taxable event. So if you don't want to trigger that, then you could open a short position instead to effectively lock in your gains. And then the next one is to hedge, and that's what we're going to do and explain in this guide. So yeah, because we're going to focus on hedging, the other ones like delta neutral, speculation, etc., that we're not going to touch on. So if you're trying to do that, this guide is not for you. So shorting to hedge is effectively protecting against potential losses of assets in your portfolio. So by shorting, you're taking an offsetting position in the assets you hold. So in case those assets price move in the opposite direction, you'll be protected. So that's very important to understand, because the goal is not to profit when you hedge, right? So One thing that means is that you don't want to hedge more than 100% of your portfolio, because if it goes past 100% of your portfolio value that you're hedging, it's no longer hedging. You're now speculating or trading. Another thing people commonly ask is, aren't we supposed to HODL? Well, I like to HODL and I still HODL, but hedging can actually be a complementary strategy because I don't need to sell any actual crypto in order to open a short to hedge position, right? The main point, remember, is to open an offsetting position. So some benefits is that you don't have to take out your crypto from cold storage, you don't have to run into a taxable event, and hence shorting to hedge may be a great idea. Also, some people may just say, I'm just going to sell my crypto and buy it back at the bear market lows. Sure, that's a good idea in theory, but because no one knows when the bear market really ends, you may end up getting faked out and end up buying back at a higher price than what you initially sold for. So because of that risk per se, it might just be better not to sell your spot crypto and instead open and close hedge positions during the bear market. Because whatever happens to those positions, it won't affect your spot holdings, so you won't ever go under the amount of Bitcoin that you have in your spot bags per se. Now, when should you short to hedge? Well, the ideal time is during sustained downtrends, and that usually comes during bear markets. And bear markets also when you get a positive risk to reward ratio for hedging. And that just means you're more likely to make profits than losses from your hedge positions. Now, how to tell if you're in a bear market? Well, just zoom out. Look at the price charts of Bitcoin or the overall crypto market cap over like, say, a 6-month to 1-year period. That should tell you if we're in a bear or bull trend. Now, another scenario is if we're ending a bull trend and then we go into a sustained sideways trend, that might also be a good time to start hedging because that may indicate the end of a bull market. Now, one thing to note is that the theoretical risk to reward ratio does get worse closer to the true market bottom. But unfortunately, because we cannot know when the real bottom is until well after it has passed, then it still may be a good idea to open hedge positions near the bear market bottom area. It may lead to a higher total cost of shorting, but that may be something you want to weigh, right? Weigh the pros and cons of that. Now, when should you not short to hedge? If you don't properly understand how these leveraged derivatives products work, then don't start shorting to hedge because they're risky and it can lead to unnecessary losses. That's why I'm making this guide for y'all so that you can minimize those unnecessary losses. If your intention is to make a lot of profits, you're also not hedging at that point. So that's not what we want to do here. Shorting to hedge is only intended to reduce or offset losses, and there may be a cost to achieve that. And I'm going to touch on the costs later on too. If you don't have money you can't afford to lose, this is not for you because while it is lower risk, there is the possibility of losing money in this scenario, especially when you start learning stuff, right? You're going to be playing around and there may be some losses that you may sustain during that time. Also, if the market is just trending up a lot, right, then short positions in an uptrend could cost too much to keep open relative to the protection it provides. So yeah, like this chart, bull trend, you really don't want to be shorting that much. What methods are available? Perpetual futures contracts. This is the most popular one, and this is the one that we're going to be using in this guide. They're easy to understand. There's no expiration dates, and there is a funding rate, but I'm going to explain that in a later section. You can also short via traditional margin trading, where you're actually borrowing the asset from the exchange and then selling it to later repay your loan. Not going to touch on that. Traditional futures contracts, that's a little bit more complicated because they have an expiration date, they have a premium or discount. Yeah, we're not going to touch on that. Option strategies, we could buy put options, which means that you make a profit when the underlying asset goes down. But unfortunately, in the crypto markets, these put options are not fully mature yet, so it's very inefficient to use them to hedge. So in this case, we're going to use perpetual futures contracts in this guide. It's the most straightforward, the most flexible, the most liquid, and hence the best way to go. Now, remember what I said. There's costs when it comes to hedging. It's not free to open a hedge. And so you got to understand these costs so that you can use these effectively. Trading fees. Whenever you open or close a position, you may pay a fee for your entire position. That means if you open or close perpetual future contracts a lot of times, that may increase your total cost of hedging. So that means we may not want to open and close all the time. Funding rate, right? This is the fee that you pay as long as you have a position open. When there is higher demand for shorts, us shorts pay the longs. And vice versa, the longs pay the shorts when there's higher demand for longs. During bear markets, it's oftentimes higher demand for shorts, which means that we will have to pay a periodic funding fee to the traders who open long positions in order to keep our hedge position open. There's also a cost of getting liquidated or getting stopped out if your stop loss hits. Every time that happens, your realized loss will get added to your total cost of hedging. That's why we want to kind of avoid getting liquidated or avoid getting stopped out for that reason. Like I said many times before, there are risks to hedging. There are pros and cons that you should ask yourself, is it worth it before you open hedge positions? Now, let's go on to the major concepts and definitions of these perpetual futures derivatives platforms. Now, they do differ a bit, but many times the same concepts and definitions apply. So I'm going to summarize these for you. And remember, with these perpetual futures, you're not actually borrowing and selling the assets, right? They're designed to act in a similar way to the real assets, but they're cash settled most of the time. So you're not actually trading any real Bitcoin or Ether. So the funding fee on most of these exchanges, we pay every 8 hours. Just be aware of how your specific exchange or platform deducts this, because it's usually deducted from your margin, and if a maintenance margin is reached, then you may need to add more capital to your margin or else your position may be closed. This does differ slightly depending on the platform, so just go read that for your specific exchange. Also, just in terms of terminology, like I said, we're not actually buying or selling anything, so the correct term is to open or close a position. For short hedging, we would sell short to open a position, and to close position, we would close short. Now, margin is the amount of money that we're reserving from our total balance to open a position. So like, let's say our total balance is like 20,000 USDT. We may choose an initial margin of 5,000 USDT to open a position with. Also, the leverage you choose affects the liquidation price. So if you have a high leverage, their liquidation price is much closer to the initial price you open the position at. And if you have lower leverage, you have a lot more room to go before there's ever the possibility of you getting liquidated. Isolated margin. This is important because this is what we want to use. This means that a specific amount from your total account balance is reserved for your position that you're opening. If that position gets liquidated, only this initial reserved amount gets lost, right? The rest of your funds will be unaffected. This is why it's called isolated. Cross margin means that your entire total balance is at risk because it's all being used as margin for your position. So you may have different positions open, but one of them, if it goes too far and gets liquidated, then it could get everything liquidated, right? So it's more risky. We don't want to use cross margin. Limit orders, market orders, these are pretty self-explanatory, but we want to be using market orders mainly when we short to hedge because we want to focus on high liquidity trading pairs and markets. So market orders execute the fastest and at a price that's reasonably close to their true market price. So yeah, if we're shorting assets with high liquidity, market orders execute quickly and you won't run the risk of missing your hedging opportunity if your limit order doesn't hit the price and execute, right? Because if it doesn't execute, you may be waiting forever, the price may drop, and then your hedge would never have been placed. There's also maker and taker fees. Maker fees are what you pay when you place a limit order that lands in the order book. And maker fees are generally less than taker fees. Taker fees are the fees that you pay when you place a market order that executes at the best available price. So like I said, we're using market orders mainly, so we're paying taker fees most of the time. Position size. This is the total USD or crypto amount, like let's say 20,000 USD or 1 BTC that you are shorting or longing. And this is roughly your margin amount times your leverage. And for leverage, this is just like 5 to 1 or 5x or 3x or 2x, right? This determines how large your position size can be with your certain amount of margin. And like I said earlier, your leverage also affects your liquidation price. Stop loss is the price you set if the price moves against you. So if it moves higher in the case of shorting, then you will trigger an order to close your position and cut further losses. Take profits the opposite. It would be set lower than the initial price, and if it hits it, it automatically closes your short and you take profits. So this section just talks about constructing your order based on the position size you want and the leverage. And it just shows you a lot of numbers to give you an example of the relationship between like your initial margin, your leverage, and your liquidation value and so forth. I'm not going to go too deep into this. You can read it in the actual guide if you want, but just know like depending on the margin size, the price can go either 100% against you if it's 1x leverage before you get liquidated, 50% against you if it's 2x leverage, and etc. Right? So it's pretty intuitive. That's why I don't want to bore you with going through all these numbers. But I do want to share with you my personal strategy. And keep in mind, it's not perfect nor foolproof. And I also may change this in the future. So this is just for an example, like food for thought for you. One thing I always keep in mind is that I'm hedging. I'm not swing trading. So I refuse to go long, and I have to fight that temptation. You can't think that, oh, the bottom must be in. Time to go long. You know why? Because if the price moves down more, you'd end up losing more money by doing that, and you wouldn't be hedging anymore. Also, I personally start hedging when I see several consecutive months of downtrends, after a parabolic blow off top, if we do get one of those, or when some technical indicators flash warning signs, like if Bitcoin's price drops below its 100-day moving average, then I may decide to start hedging. That's just one example though, and I'm not a technical chart guru, so you got to go learn that for yourself and decide on which indicators you want to follow. Or if something major changes in the market, like when the Fed starts to raise rates, or if a big crypto exchange collapses, then you may want to start hedging. Now, when do I stop hedging? There's really two approaches. The first one is if prices drop low enough that you're happy to just close your shorts and you take that profit to scoop up some coins for long-term holds. This needs to be at a price that you're comfortable at though, because if prices drop even more, you don't want to panic and start to shift your strategy. The second approach is you don't stop hedging and you continue your hedge until you're confident that we're back into a bull market. So once again, you'll have to make your own judgment as to when we're really back in the bull market. And also with this approach, you may lose more initial hedging capital, but that may be okay because the value of your spot holdings will be way higher too. The second approach is actually what I do. So I'm going to be hedged well into a bull trend until I'm confident that we're back into a bull market. How much capital am I hedging with? Honestly, I'm only hedging with like 10% of my overall portfolio as my like total margin available balance. And I may use some leverage on top of that. And I know that doesn't cover my entire portfolio value, but that's okay with me because I don't want to risk that much for my hedge. Now, in terms of leverage, definitely start with low leverage, like 1x leverage when you're learning. Get comfortable with that. And then maybe 2x leverage or 3x leverage at the very most. If I'm anticipating a big move or a lot of volatility coming, I may open a little bit more higher leverage, like 3x, right? If I'm anticipating a big down move. But if the price moves against me in a big move, then I may close my higher leverage positions and open up a new position with like 1 or 2x leverage to wait to see how price action develops and reevaluate. That is just what I do currently, but I may change this in the future if I find something else that works better for me. So yeah, but just please don't go above 3x leverage or else it can get too easy to get liquidated and that defeats the purpose of your hedge. And I pretty much just stick with shorting Bitcoin or Ether because they're good at representing the overall crypto markets. Do not short illiquid smaller crypto coins as they're way too volatile and you may get like scam wicks, scam pumps that stop you out or liquidate you even if you're right about the general direction. In terms of stop losses, I generally don't set those that much because I just instead use low leverage. I'm not really at risk of getting liquidated, and I check my positions multiple times a day to adjust them manually if need be. If you do use stop losses, just keep in mind that if they hit and then you're out of a position, then that's not good, because if prices drop after you get your stop loss triggered, then you're not hedged anymore, right? And we want to be hedged. Definitely check your positions a lot, once or twice a day, especially if a big move happens. Like I said earlier, if a big move happens in either directions, I like to close my positions, readjust leverage, maybe readjust the coins that I'm shorting to hedge. So that's just what I do. And I usually don't worry about funding fees too much, because a big move can happen at any time, so I don't want to be sidelined and out of a position. Also, because I'm using less leverage, deducting the funding fee from my margin or balance shouldn't put my position at risk that easily. But do just check that for your exchange or platform that you use. And now it's time for the Bybit step-by-step tutorial. And like I said, if you do decide to use Bybit, it would help me a lot if you use my referral link that I'll leave you in the link below. But let's shift our attention over to that platform. And here we are, the homepage of Bybit. And you want to start out by going to deposit right here under assets. You should deposit USDT. You can change the chain type to ERC20 and deposit here. And then afterwards, go to funding under here, switch to crypto, and next to USDT, click transfer. From funding to derivatives. Remember, transfer some balance, press confirm, because we're going to trade derivatives. Under derivatives, go to USDT perpetual, and here's your main ones: BTC, USDT, and ETH USDT. These are ones I'd stick with. Other ones, nah, too risky. So let's go for BTC USDT right here. I mean, this is pretty much what you'd expect, right? But on the left side, you want to make sure you're at standard, and then click here. It's usually on cross, right? So change it to isolated. This is incredibly important. And then you can change your leverage. I like how Bybit gives you smaller increments, but let's just set it at 2x, right? Go to market, not limit. We want to do market. And then let's say we want our position size to be 2,000 USDT. Because it's 2x leverage, that means our cost or our initial margin will be around 1,000. And then you pretty much press sell short and it'll open a position. You can also place take profit and stop loss orders here. Pretty self-explanatory if you want, or you can set them later. But once you do that, the position will show up down here, and it'll show you like how much unrealized profit and loss you have. And you can also close your position by clicking on the button under the close by column. So that's pretty much it, right? Like right now I have hedges open, not on this account, but another one. I'm just monitoring it, and if it goes against me too much, I may close it and reopen something with less leverage, or I may take profits manually too. Like let's say Bitcoin crashes a lot, this is going to be in heavy profits. I will close it and maybe open a new one, because remember, I want to stay hedged as often as I can. So I'll open a new one with less leverage. Let's just go all the way down to 1x and position and sell short, right? And then that will be good after a big move, and then you can reevaluate later. So I'm hedged as we speak. I know it's deep in a bear market, but I think it's still worth hedging with all the potential risks out there and uncertainties, right? So it's pretty simple though, using Bybit to open and manage your hedge positions. Okay, I hope you feel more comfortable now about shorting in general and have the tools you need to get started with practicing. If you want to read the complete guide, I'll leave you a link below. And also, if you want to support me and follow along the tutorial portion, then please use my Bybit referral link, also in the description below. See ya!